Hi, everyone, and welcome to the week ahead. I'm Tony Nash. Today, we're joined by Michael Ncoletos, Bob Iaccino, and Albert Marko. We're going to talk through the upcoming US dollar squeeze, which Michael has just published a stellar piece on this. We're going to talk with Bob about year-end markets and see what we're heading into. And then we're going to talk to Albert about some geopolitics, specifically about Argentina, but kind of how does that apply more broadly? So looking forward to the discussion. Guys, thanks so much for joining us. Hi, everyone. We've started our Black Friday sale at Complete Intelligence, and you can subscribe to CI Markets for $99 for the whole year. That's 80% off our normal price of $500. Starts today, and it goes until November 28th only. Go to completeintel.com/Black Friday and subscribe to CI Markets for $99. Thank you. Michael, you and I met a few years ago when I was giving a presentation on China, and I used one of your charts on the weakening efficacy of Chinese debt issuance. And it was so great that you were there. I didn't know you were in the room, and the humility you had around that was just astounding. And so I follow you really closely. We've been talking about the dollar for a long time. Albert talks about the dollar a lot, and you published a paper a couple of weeks ago about the coming US dollar squeeze. So this is really, and pardon me for oversimplifying it, but it's really a story of interest rates and viable alternatives to the dollar. Obviously, there's a lot more to it, and you outlined kind of a 7-step process. So would you mind walking us through that? I've put up a chart on the Fed funds rate to get us started. Would you mind walking us through each of those steps, kind of as an overview?
First of all, it's great to be here. I also enjoy your work, so I share your thoughts about your work, thank you for sharing with everyone, and love the discussions we're having. It's sometimes you bump into someone by luck. So I think we bumped into each other by luck.
That's right.
And I think it was in the Cayman Islands, right?
That's right. That's right.
So a Greek, and you're from Texas, right?
Yes, that's right. Worlds away.
We met in the Cayman. That's
not a bad place to meet.
How small the world is. So a few weeks ago, I was thinking about the dollar, which I'm one of these people who think that the dollar is unlikely to weaken unless the U.S. government or the U.S. Fed decide to do so. And the thinking is, we've been reading and we've been reading a lot about the U.S. deficits, about the situation in the U.S. and its fiscal responsibility. And we've seen a lot of people talking about the new currency, the BRICS currency that could replace the U.S. dollar as the global reserve currency. So I tried to lay out why I think the dollar is not going to go lower. And by lower, I mean it's going to squeeze higher for a few reasons. After the 13-year expansion of the U.S. balance sheet, which I think the balance sheet reached around $9 trillion, if I'm not mistaken, the Fed decided to stop that and to start raising rates, and then to start QT. So in the first phase, the Fed just started raising rates. And by that, when you raise interest rates, you effectively drain liquidity from the world in US dollars, because a lot of dollars, as simplified as that can be, are going to go to the currency which has the higher interest rate, assuming that there are no capital controls, nothing else. So that was the first step. The second step was that the Fed stopped QE. And by stopping QE, stopped reinvesting the treasuries that it had bought and the mortgage-backed securities, which again, by stopping reinvesting, means that these new issuance need to be bought by the market. So when the market needs to buy them, and it's not the US government, more dollars are used for that. You need dollars from the market, which would be used for something else, to buy these treasuries and these mortgage-backed securities. Then the Fed moved a step further and started QT, which means it started reducing its balance sheet. So when you reduce a balance sheet again, which means you need more money from the market to start buying these treasuries, more liquidity started to drain. Now, if we put all this together in an economy that is going through, let's say, a Cold War, you want to put it this way, with China, in a world where there is reshoring, and in a world where there are few wars going around. So there is a supply issue in terms of how inflation is created. You have less oil, so oil prices go up. You've had an inflation scare across the globe, and which has translated to real inflation. Now, in normal conditions, when you have a supply-driven inflation, the remedy is not to raise interest rates, because monetary policy is effective when inflation comes from the demand side, not when it comes from the supply side. The Fed of San Francisco published a research paper a year ago, I think, showing that 2/3 of the inflation in the US was coming for supply reasons. So the question I asked myself is, if what I'm saying is correct, and I'm pretty sure the people of the Federal Reserve are pretty aware of it, why are they raising rates and increasing the deficits when this is clearly not going to do much on the inflation side? Okay, we've had the pause, we've had an inflation coming down, but we need to see where it's going to stabilize. So the question is, when you have fiscal deficits, and fiscal deficits are around 7 and 8% of GDP, and you don't have the central bank buying treasuries to fund that deficit, it means that these bonds, which according to a report I read, I think next year it's 8 trillion, 8 trillion need to be financed for the US government. So $8 trillion need to be found from the global market to fund that deficit. Now, most people are aware of the dollar and how it works, but most people are not aware of the euro-dollar market. You've raised it a few times, but most people don't understand. The euro-dollar market are effectively all the dollars that are not included in the USM2. And we can go into specifics what's included and what's not. It's very technical, but I don't think it doesn't make sense to do this discussion now. So all the dollars that are not included in M2 are the euro dollars, which are outside the US, which it's equivalent in size of the US dollar market. So M2 is around 20 trillion. Imagine that there's another 20 trillion or maybe more outside of dollars. So what's the problem with that? When the dollar goes up, you effectively create an issue, especially on emerging markets. Why do you create this problem in emerging markets? Emerging markets, because they do not have hard currencies, tend to issue debt in dollars. So they tend to issue debt in dollars. The interest rates go up. Their bonds go lower, so they have a funding need. They either need to put dollars in to bridge the gap, or they need to start selling bonds, or it's not as easy as one would think.
Michael, let me just pause there and ask you a couple of questions. You said the US needs to raise $8 trillion in debt next year. Is it possible to have a failed auction?
I guess it could be, but why would there be a failed auction? The interest rate will go higher.
Right. That's the answer. So I hear a bunch of the kind of dollar naysayers go, well, the US is trying to put so much debt out there, they're just going to have a failed US Treasury auction. But what you're saying is, no, they'll just, the US will just offer a higher interest rate on that in order to sell that. Is that right?
Yeah, but let me put it this way. There's this chart floating around, especially on Twitter, about the liquidity of the US Treasury market. Okay. This is ridiculous. And I'm saying it's ridiculous because the US Treasury market has an average trading volume of like 15 trillion a month. The next one is the Eurozone with 6 trillion. And then it's Japan with 3 and China with 2 trillion per month. So if US dollar bond liquidity is going down, imagine what's happening on the other markets. We've seen the Japanese bond market not trading for a day. We've seen so when we talk about liquidity, and I'm not saying that liquidity is going up, I'm saying it's going down, but it's a relative discussion. It's not an absolute discussion.
That's
so
key.
What does that mean? You're going to buy
Everyone
what?
has
Japanese
to understand
bonds?
Currencies are relative. It's all relative. And I think that's something that
currencies are relative. And what's more important, people need to understand that the dollar's position is a derivative of the US capital market system. The US capital market system is so efficient at least in terms of anything else that we see right now in the world. So when a government, whatever government, buys, trades in US dollars and accumulates US dollar FX reserves, they can buy at the split of a second US treasuries, and they can sell at the split of a second US treasury. There's no such issue. Now imagine doing the same, accumulating one, for example, or rubles in FX reserves, and then one day needing to sell them. A, there's no liquidity. B, if you manage to sell them, there are capital controls. You need to take them back. How will you take them back when there's capital controls? So the next most efficient is the Eurozone. And the Eurozone is not one market. It's Germany, France, Italy. So when we talk about the Eurozone, we're not talking about the 20 countries. We're talking about 3 or 4 countries within the 20. So again, when we talk about the US dollar, it's a relative discussion, but it's also a relative discussion of the capital markets they are representing.
Right. Okay, good. I just wanted to get that out of the way. The other point I wanted to raise was you said emerging markets need to raise their debt in US dollars. And I don't think that's really well understood by a lot of people. So if you're in like an Indonesia or Sri Lanka or whatever, if you need to sell debt to international investors, because you're not really going to raise that in domestic markets, are people overseas going to take the currency risk along with the sovereign risk?
Well, let's put this, Turkey has interest rates at 30%. They issue debt at 30%, or they're going to issue debt in dollars, which will be at like 6-7%, whatever the number is right now.
Right.
They're going to try that, and they're going to hope that the economy recovers. And as the economy recovers, their currency is going to become stronger, so the debt repayment is going to be cheaper. In theory, all very nice. But when the dollar goes up, it creates a squeeze on the world, on the growth, on the collaterals, on everything, which makes things much worse for all these countries. Unless they have current account surpluses, which they can, once they have, they can sustain that period for a longer term than the others. But again, they're going to get squeezed as well. There's no hope. So all these countries that raise debt, dollar debt, or foreign denominated debt, in the last 10 years, because rates were at zero, now are facing issues because what we've seen, the discussion that happens right now in US banks about the collateral that banks have, and that the treasuries that they hold have a mark-to-market loss, as we've seen, which effectively it's not the case because the Fed made the
PTFP,
which they accept at face value the bonds. Now imagine what the US banks are facing, countries facing it, without the BFTB to protect them at face value, and with them needing to refinance that debt at the worst possible time. So if you're asking me, the squeeze will not go in the liquidity of the US Treasury market. The problem will be in Turkey, China, Russia, Indonesia, Egypt. These countries and all the others are going to face Argentina. They're going to face issues when raising debt because their capital market is not deep. When you buy these bonds, you marry them. If you don't marry them, you're going to be selling at a deep discount the day you decide to sell them. And you have more issues. So we tend to talk about the US, and I want to make a point. The US financial situation is not good, definitely, and I'm not saying it's good, but I'm saying the way the world is structured, and the US being the global reserve currency, it's less bad than whatever everyone else is facing.
Yeah. I hadn't thought about the sovereign debt issues before today, but now that you mentioned that, that's Silicon Valley Bank all over the world at a central bank level, right? At a finance ministry level.
Let me put it simple. I'll put it as simple as possible. When you can buy U.S. Treasuries, 2-year Treasuries, at 4.9%, 492 there too. So 5%, let's say 5%. You buy 5%. You buy U.S. Treasuries, the safest asset in the world. You gain 5% a year, and you sleep like a baby. So when you invest, you need to think: is there something that's going to give me a higher return, and it will be relative to me sleeping like a baby and gaining 5%? This is as simple as that. Because if I'm gaining 7% and I'm not sleeping at night, it's not worth it. So I need a higher return, and this higher return goes with the countries that are hard to find the finance.
That's right. Bob, what do you think about this?
Well, I think the perfect end to that extremely impressive summary of what's going on in the global markets is the sleep at night part that a lot of investors seem to ignore when we've gone through let's just call it multi-years of bull markets in equity assets. Because investors tend to forget, and I'm speaking a little bit more to retail because I believe institutional investors know it, but sometimes they don't. Let's take the example of a hedge fund, for example. Hedge funds are supposed to perform when equities are performing, and they're supposed to outperform when equities are collapsing. And one of the things I like about this format versus the traditional financial media that unfortunately I've been a part of in theory since 1999 is that they tend to have this view that positive performance is the only performance that matters, and outperformance, they'll put somebody on TV and they said, you've outperformed the S&P this past year. The S&P is up 12% and you're up 15%. But when the S&P is down 24% and that particular person is down 18%, they'll come on and say, well, you're down 18% this year. So, I mean, well, you're still outperforming to the opposite side. And it's one of the things I talk about a lot, and I'm digressing a little bit, but outperformance to the downside to me is much more important than outperformance to the upside. And to Michael's point, if you can make 5% and sleep at night, that to me is worth an extra 5%. Okay, that's just the way that my internal math works. It's not some sort of technical formula that I can explain. You need to double my return to take away my sleep at this point in my career is basically what I'm saying.
Yeah, and large institutional investors, are they looking for 30% returns a year? I mean, they're not necessarily looking for 30% returns a year. That's crypto level, right? So
when I was part of the investment committee at a fund of funds that I was a principal at, we went into these big investors, and I'm not going to mention the fund because it's dissolved at this point, but we had 10 years of returns where our worst year was down 46 basis points. Our best year was up 8%. Okay, and that was what the fund was designed to do. But when we went into large allocators, they would say, God, I just love your returns, but you represent nothing but risk for me. Why? Well, because you don't have a lot of money under management at this point, and we worry that allocating to you would affect your performance, which it wouldn't have, but whatever, didn't happen. And that stuck with me for a very long time, where these large institutional asset allocators are very worried about sleeping at night because their management fee matters more so than beating their last year's performance by 1% or 2%. And that's something a lot of investors don't understand. I mean, again, I'm digressing a little bit, but it goes to the point of how much it matters that the safest asset in the world is between 4.5% and 5%, depending on what duration you put on it.
Yep.
And that matters a lot, and that will continue to draw very large capital for a long period of time. And that capital won't necessarily leave those assets for 25 basis points here or there, or 50 basis points here or there.
Right. The interesting part.
Can I add something? Tony?
Yeah, absolutely.
I agree 100% with Bob. You're being paid to wait for the first time in your life after 20 years. Yeah. You're being paid to wait. That's a great way to put it.
That's a great way to put it.
You're being paid to wait. It's never, for the last 20 years, this hasn't happened. So you're being paid to wait. And when there is a correction, if there's a correction, or if there's a recession, or if there's a depression, whatever, I won't go into what could happen. You'll have money on the side being paid and being able to deploy it as you wish, having the most liquid asset in the world, which you, at that point, will probably rally. So you'll be making a couple of gains as well. And you'll be doing the best thing you can do. So,
and if I can add to that, Tony, we have 5 trading days left in the month of November, really 4. I mean, Friday is kind of a lost day, so to speak. But so we have 4 or 5 trading days left in the month. Let's call it 4.5 in the equity markets. You're about to post your greatest November percentage-wise on record to the upside for equities. And the volume is barely half of what it was in October. Now, it's not going to make up the rest in 4 trading days. I mean, I guess it theoretically could, right? But it's not. What does that tell you about the overall stance of the institutional investors? They honestly, in huge dollar amounts, they have not been involved because what Michael said, they're being paid to wait. And if you look at the overall makeup of this particular earnings season that we're basically finished with, right? It's been good, right? But we have the weakest buyback numbers announced since 2016. We have the largest negative reaction on individual stocks that have missed earnings expectations since 2011, largest drop on misses. And we have the largest cut to estimates since the second quarter of 2020. So what does that tell you that these analysts and these investor relations parts of these large companies are thinking? They're worried. They're not mentioning recession as much. As a matter of fact, it's the lowest mention of the word recession, I believe, since 2022. But they're not positive overall, even though there's beats on the outright figures.
Because the risk appetite is, it's mitigated by what Michael's talking about.
By what Michael's talking about, exactly.
Right? It's great. So let's get back to this this USD thing for a few more minutes, and then let's move on to markets and talk real deep with Bob. So, Michael, you have a chart showing the foreign exchange turnover by currency, and of course, it's overwhelmingly USD. And of course, we've had some growth in CNY since, say, 2010, but on a relative basis, where is that CNY taking kind of market share from? Is it taking it from British pound, or where is it taking that market share from? Is it from the dollar?
I say mostly from the euro.
From the euro, okay.
Yes, but again, China has done like 40 swap deals since 2016. They've been trying to make their currency more usable, let's say, as simple as it. But again, everyone who trades in China in yuan, they will do it at the equivalent of a barter size trade. They will not do the extra mile to accumulate FX reserve. So if I'm buying 10, selling 10, I'll use that 10 to do it in one. But if I'm doing 30 and 40, but the 10 is only the bilateral trade going both ways, I don't want to accumulate Chinese.
Right. And here's one of the key things there that I don't think a lot of these kind of CNY cheerleaders understand is, if people accumulate CNY, they're trusting the People's Bank of China, right?
And they're trusting they're going to get their money back when they want it.
Right. But when we look at the currencies on this chart, it's the Fed, it's the ECB, it's the BOE and the BOJ, very highly covered, and I wouldn't say transparent, but relatively revealing on some of the decisions they're making. I don't remember the last time I saw a PBOC press conference like open where people could ask questions, like real questions. And until we can have that level of questioning of a central banker, it's really hard for a country or a company to accumulate that currency because they have no idea what the policy of that central bank is going to be. Is that fair?
Tony, before you get, you have to take off the capital controls. I'm not.
Yep.
Who in the right mind going to accumulate a currency which has capital control? We're talking about the BRICS currency, okay? Yep. There's a discussion. 2 out of the 5 countries have capital controls. 2 out of the 5 have capital controls. And the half of them don't trust the other half within the BRICS.
Yep.
And we're talking that this is going to be the alternative to the US dollar. Okay.
It's great. Put them in the ring together.
Okay. If you want to believe in Santa Claus, you can believe in Santa Claus. But as things stand now, this is no option. Sorry.
Is Santa Claus not real?
Sorry.
Yeah. So we're not going to reveal that on this show in case there's kids watching. So let's take this kind of full circle to this great chart on risk premium from EMs to the US. And I know we covered this a little bit, but seeing that risk premium really disappear, what is that? I mean, effectively, that sucks all the money back to the U.S., right? I mean, it's like you said earlier. What's the point in investing in emerging markets if you have a guaranteed return, a U.S. dollar denominated guaranteed return?
It comes back to what we talked earlier. Again, that's what I agree with you 100%. If you're getting 5% for the safest asset, you need to at least get the double in order to get the risk. Okay, obviously. It depends on the risk anyone can take. But let me put it this way. When you take risk, you need your upside to downside risk to be skewed on the upside. So if I'm willing to make 5% to lose 5%, there's no point of having the discussion. If I'm losing to make 10% to lose 5%, that's a 2-to-1 or a 3-to-1, then it makes sense for me to make the investment. So a 10% return is something I'm starting to consider in order for me not to put it at the 5% and sleep at night. So to quantify what Bob said easier, I'm thinking it in terms of how much you're going to make in terms of what you can lose. So a 2-to-1, 3-to-1, whatever that is. But it should be something bigger. So if it's 1-to-1, why bother get something riskier with the same return when I can buy something which there's no risk, or at least there's never no risk, but there's very small risk.
Right. And the other thing that I try to reinforce with people that is so basic that some people look at me and think I'm stupid by saying this, but interest rates are the cost of money. And if money costs 5% in the US, money should cost a lot more in riskier markets, right?
Correct.
That sounds really stupid, but that's just the basics of it. So
no, it's very simple. Unless you're safer than the US, you're safer than the US, which safer doesn't mean only a fiscal situation which is better. It means you have rule of law, you have an open capital markets, you have a democracy. There are a few things when we say safer. It's not just numbers. So if you have an overall safer economy, then you should justify a better interest than the US. If you're not safer than the US, then you need to justify a higher cost of money, as you said.
Okay. Hi, everyone. We've started our Black Friday sale at Complete Intelligence, and you can subscribe to CI Markets for $99 for the whole year. That's 80% off our normal price of $500. Starts today, and it goes until November 28th only. Go to completeintel.com/Black Friday and subscribe to CI Markets for $99. Thank you. And so we always hear about China being in the ascendant. So Albert, as we saw that Chinese vessel with smoke coming off of it yesterday, do they have, is China a real competitor right now if they don't have a navy to enforce their policy?
Nope. Simple question is absolutely not. They don't have any sort of maritime naval force to enforce any of their trade activities globally. I mean, everyone points out, I think I've seen some charts out there of, oh, look how many ports that the Chinese own. Yeah, but those host nations can evict the Chinese at any point in time with absolutely no repercussions. So it's like,
so does DP World out of the UAE. And do they command a world trade? They don't. They run them as a business.
Yeah, it's exactly right. So I mean, these comments of China being a competitor to the dollar or the U.S. in the near term is just it's a lame argument. It's silly. I don't take any of it seriously.
Great, Michael. Do you have any view on the timing of this squeeze? Are we in the middle of it now? Is it something that's coming in a few months? When do you expect the intensity of it to really hit?
Well, the Fed doesn't need, first of all, to raise rates anymore. It can stay here, and the problem will continue. As the deficits grow, more dollars are needed from the market. So I guess next year is going to be a bit tricky, unless, of course, because and I mentioned this in the paper, because we have U.S. elections, and because of U.S. elections, you never know what the government will do. Maybe they do another QE, or if it's not a QE, it's something with another name, not to call it QE, and they drag liquidity into the system. This thing might pose, but I think positioning in the dollar in the next couple of years, you're going to see the dollar much higher.
Hmm.
I agree with that. I mean, that flows right into my my political outlook, where in order to combat inflation, they're going to have to keep the dollar up high. That's just, either raise rates or keep the dollar up to a level where it just suppresses inflation over the long run. That's same view as me.
Interesting. That's great, guys. Okay, so let's move on to the next topic on year-end markets. Bob, you already mentioned there's only a few trading days left in November. And I know you cover a lot of markets every day. So I'd really like to get a sense check on where we're going into the end of the year. We have higher interest rates globally, like we just talked about. Inflation seems to be abating, at least for now, and we can debate the magnitude of that. We have some geopolitical factors, but they seem to be easing, especially US, China, these sorts of things seem to be easing up a little bit. Of course, there's the Iran Hamas thing, but that's, relatively local. Spending seems to be slowing. US retail sales and all this stuff are down. We've had some kind of dire retail outlooks for the holiday period. And at the same time, corporate profits peaked in Q3 2022. You mentioned earnings surprises and stuff earlier, but they're slowing. So I've got a chart up showing corporate profits, and they're down, fairly at a significant level since 2022. So what are you looking at as we go into the last month of the year?
So one of the things I'm looking at from an equity market perspective is what's going to break first. And the reason I say what's going to break is because I think it is a matter of what and not if. I think the soft landing scenario, you would have to believe that the Fed was possible of creating a soft landing. They were capable of it, which I don't. In order to, and you would have to allow the Fed a victory lap, regardless of, I agree with what Michael said, when you have supply side driven inflation, the Fed doesn't really have a lot to do with it, but they have been successful when you look at the data in slowing the housing market. And that's about it. And you need to see other slowing in order to believe that inflation is actually going to get to their 2% target, or they need to accept something higher than a 2% target. Now, whether they know it or not, they left the door open for that a couple of years ago when Jerome Powell said, because we've been below 2%, I'm paraphrasing, of course. He said, when we've been below 2% for so long, we may need a little bit of time above 2% in order to reach an adjusted average of 2% inflation. I still don't know what an adjusted average is. We didn't learn that in statistics class. We just learned average. But so he could actually at some point down the road say, you know what, we're at between 2.8 and 3.1% is okay for now, which, to the point of the elections next year that Albert brought up, I think that could be one of the things they say going into the elections. They could actually put pressure on the Fed to say, well, we're allowing it here for a little while, and we'll reassess in 2025 to see if we need to do anything more. Also, wages are growing at a rate, when you look at sort of the 3-month average of real wages, you're seeing a level that isn't consistent with 2% inflation. It's much more consistent with about 3.2 to 3.8, 3.2 on the core, 3.8 on the headline. So the driving factor for me going into next year really is energy. And I'm a little biased because crude oil is the thing I trade the most. But as you mentioned, I look at 29 markets every single day, and when those are boring, I go to individual equities. But energy markets to me are the number one thing, because despite crude oil, I think crude oil is trading at about $74 on NYMEX right now, 78 on Brent. That's still high historically. And we actually talked to Tracy Shukart, Shy Girl, about that on a recording that we'll release this coming Monday. This coming Wednesday. But she's the one who brought it up, and it struck me because we tend to think as $70 oil as being, wow, that's okay. We're back down below $3 a gallon. But that is still a relatively high price historically. Put that up against the higher interest rates and I got in trouble for saying this on a Bloomberg TV interview about a year or so ago, where I mentioned that there were somewhere in the range of 37 to 40% of C-suite people in the S&P 500. But the last time we had rates this high, they were in high school. Some of them weren't born. And the journalist that was interviewing me at the time got offended because she was in high school the last time rates were at this level.
You should be bragging, right?
No, I know. I mean, she should be. She should have been like, that's me, that's me.
Right.
And she said to me, well, they could read, Bob. And I could tell she got offended by that. And I said, I didn't say that they couldn't read. What I said was, and I'll go to the old Mike Tyson quote that I bring up a lot, everyone has a plan until they get punched in the face, right? And these people are about to get punched in the face with rates they've never had to deal with. You take Silicon Valley Bank as an example. They're out there having DIE parties, and I'm not judging that, rather than hedging their hold to maturity interest rate risk, right? Because they'd never had to do it before.
Yeah, there was at zero interest rates, there's really no, you have the nominal, say, punishment for risk, but nothing beyond that. Right. Now your punishment for risk is multiplied over the nominal cost.
And you brought up the cost of money, which is a very real thing for consumers as well as investors. So we're going to go into the holiday season is a big deal to me, and energy prices are a big deal to me. How much more do consumers stretch themselves even at their higher wages? Because while we're looking at potentially 2.8 to 3.2% inflation next year, that's on top of the inflation that we've already had. You know, the news media tends to do consumers a disservice by saying inflation is falling. That does not mean prices are falling, and the three of you know this. That does not mean prices are going down. That means the $30,000 car that became a $38,000 car is now a $40,000 car. So the increase is not as much, but prices are still increasing. So you pile on higher energy prices, which is not a guarantee. It's not a given. And I think there's a lot of trouble going into maybe Q2, Q3 of the markets next year.
Yeah, I'm with you, Bob. I feel like the consumer is really stressed, but I hear this stuff every day with people telling me the consumer isn't stressed, but I see it in front of my face every day when I go out into
stress. Paul Krugman put an article out about it was about a month ago, and I just recently found it and retweeted it because of the just complete ridiculousness of his stance, saying that consumers are complaining about their financial position, but it's not as bad as they think. I'm like, what the hell are you talking about?
Right.
Somebody says they can't pay their bills, and Paul Krugman's out there saying, yes, you can.
Right.
What are they talking about?
He could pay my bills if he wanted.
Paul Krugman is nothing more than a Democratic mouthpiece at this point. He doesn't say anything relevant to anything economic at this point in time, in my opinion. Every time he speaks, he just says something more ludicrous that is just absolutely out of bounds.
And I couldn't agree more. And I don't care that he's a Democratic mouthpiece. Just say you are.
Yeah,
don't call yourself a Nobel Prize winning economist anymore, even though that's technically a fact.
So I'll say this in Krugman's defense. Okay. I had his international finance textbook in grad school, and he writes an amazing textbook. So we've got to give him his due, right?
That's the problem, is because the guy knows he's a smart guy. There's no question that he's a smart economist, financial guy. But I mean, for him saying these ridiculous things that, yeah, you can pay your bills, even though everything's 30% more than it was, 3 years ago, is insane.
Right. And credit cards are loaded up and all that stuff. So I want to ask you about tech. Okay. So, we have a massive concentration of equity risk in tech right now. And I've got a chart up on the screen showing kind of the relative concentration in tech compared to other sectors. And it's interesting, you mentioned energy, and if anything, people are less concentrated in energy than they were a year ago. So Tracy Schuchart actually posted this earlier this week. So what are your thoughts on tech? I mean, we just saw this OpenAI mess, over the last week, and OpenAI is the kind of peak of tech right now, right? And the governance in OpenAI is terrifying. And we all saw it play out. And live. And, I would submit that the governance in OpenAI is more representative in the governance in tech than not. And so we have this concentration of investment in tech, which is risky anyway. And then we have governance issues playing out, and people want to act like that's not relatively normal in tech. So can you talk to us about your views on tech and what you see? Like, is OpenAI, do you think, reflective of governance in other tech areas?
Well, I have no insight in a company like OpenAI, but what I do like to look at is sort of an equity sector backtest and kind of describe what the 4 sort of sections of equity market performance look like to me. And one of them is recovery, which is faster growth, slower inflation. Another one is deflation, which is slower inflation, slower growth. And then you got reflation, which we went through a bunch of years of with faster growth, faster inflation. And then you have stagflation, which we all know what that is. It's faster inflation, slower growth. In 3 of those scenarios, tech is in the top 5 in terms of their historical returns. Worst case scenario, they're in 5th place if you have slower inflation and faster growth. But I think we have a better chance of stagflation or deflation over the medium term, and tech performs poorly in deflation, but doesn't actually perform that badly in periods of stagflation. Now, granted, we haven't had that many, but the number 1 performer in sort of faster growth, faster inflation, and faster inflation, slower growth is energy. So that's why, again, I look toward energy, because in 3rd place in both of those backtests is technology. So if energy is rising and it's having an effect on inflation to where we have inflation not quitting, I kind of want to be in tech, even though that might point to higher yields. But when you look at a yield equity backtest, the only time tech suffers is when the yields further out are struggling, specifically the 10-year yield. If the 10-year yield is rising, tech tends to underperform. If the short-term yields are rising, so let's say that the Fed is hiking and the market thinks that it's going to work, tech outperforms again. So it's difficult for me to see stocks going up without seeing tech going up. But my base case is actually the stocks don't perform that well in 2024, specifically in the second half of 2024, which would mean tech would lead to the downside. Does that make sense?
That makes total sense. And so do you think...
Can I add something to that?
Yes, please.
Well, I agree 100% with Bob. Technology, mostly the ones that do not have, a bottom line, are a duration asset. So when your duration gets hit, they get hit as well. So it's as simple as that. When they have a bottom line, then it's a DCF, and depending on your discounted cash flow or whatever net present value or whatever you're doing, then you can assess a value which may be doing better or do well. But again, I think you hit it right on the nail on the head. So I think I view it the same way. I just wanted to add that.
Albert, what are your views on tech?
As long as the higher interest rates are remaining, I don't know what tech's going to be how they're going to be able to perform going into 2024. I mean, obviously the Fed likes to use, the Mag 7 stocks to pump markets, but, long term, it's just, they're so riddled with debt and they're holding it, and their interest rates are just, higher for longer. And as long as the market is offside again on this like pivot or rate cuts, I don't see what tech's going to be able to do in 2024. We're already at stratospheric levels on tech. I think with Nvidia is like 35 times earnings or something like that. It's absurd. I'm not really. I agree with Bob. I don't see much of what tech could possibly do. Would I not want to? I sure as hell want to hold it if the market dips, knowing full well what the Fed can do. But for me, I don't see much play here going up.
Sorry, Nvidia is 116 times earnings right
now.
now.
Sorry. I was probably referencing 2021 levels.
So just to break that down, is the market is saying that it will take 116 years of earnings to properly value the equity price today? That's what the market's saying right now, right? I mean, you guys trade more than I do, so I just want to make sure I have that right.
Yeah, that was the very first definition that was given to me.
Okay.
Well, yeah, the very first one I've ever learned. And I've always kind of held that in the back of my head because, yeah, I mean, even if you're looking at 35 EPS during times of bull markets, the things that people are buying are between 28 and 40, and then they get as high as 116, obviously. But, to what Albert said and to what Michael reiterated in the simplest of terms, again, thank you for that. When these companies raise money, they like to go to the public markets. And if the public markets aren't doing well, they are not going to like what the yields do because the vast majority of them are not that cash positive. We're not talking about the big seven here, right? We're talking about the vast majority of the tech sector. Now, how much has to happen for the tech sector to drag the big seven down? Well, I think that's more a matter of taking profits than anything. One of the biggest moves lower we see in these high-flying names, and I'll throw Apple in there, even though Apple is probably more of a value stock than a growth stock that it used to be. They will sell those because they don't want to lose on the other positions. They'll sell them for to cover options positions, for margin calls, things like that. And that's when those start to get hit. There was the big news story about Michael Burry of the Big Short fame betting against the stocks, right? The semiconductor index. And they talked about how he took $47.6 million position. We took it in options, so it's not $47.6 million. Again, the legacy media doing a terrible job at everything. And by the way, sidebar, legacy media would want us to argue about this stuff rather than agree and have a consensus as to what things are looking like. That's why I like these formats so much more, because if we do agree, we should be allowed to agree. And it's part of the reason I got kicked off CNBC for having that fight. But anyway, when you're talking about moving forward, what can happen to the tech sector, we all acknowledge and understand that tech is going to lead the future of all nations. So when you're buying a currency, the first definition I learned of buying a currency is you're buying a share of stock in that country's economy. So if you're advanced in tech, the currency tends to benefit from that, and hence the US dollar remaining strong for a long, long time, among all the other things Michael mentioned. But when you're looking at tech falling, tech will be the first thing that people buy dips of. And it will also be the first thing that they cover when those buying of dips don't work, if yields are higher for longer. Because these companies will need to manage a lot of their cash flow based on higher yields, which they have not had to do for 2 decades. And I think that backs up both what Albert and Michael are saying in terms of why yields actually matter. They don't matter for inflation today. They matter for the condition of the economy 18 months from now, 2 years from now, and how we adjust to these inflations. Because again, I don't even know how many of us on this stream are old enough to remember those rates. I remember my dad dancing because he got 6% on a house. He was thrilled because his first house was at like 14% or 12%, right? So this is a very new phenomenon, even rates where they are now. And I wonder if the Fed will blink. I don't know if they will or not. I'm curious about it.
I remember my parents with a double-digit mortgage in the early 1980s. Mm-hmm. So, we have a lot of Treasury people and a lot of CFOs who I don't know if they're ready for yes, they can read, but I don't know if they're ready for the lessons that they're.
No, I mean, my father literally danced. He had a friend who had an accordion and knew how to play it. And he danced the tarantella for about 15 minutes because he got 6%. I'm sorry, I'm a child of immigrants, and that's what we live with.
Fantastic. Okay, great. Thank you for that, guys. Hey, let's talk about Argentina for a little bit, but because of course, we had that big election in Argentina, and we saw a radical libertarian, and according to Bloomberg, a madman, Milei, elected in Argentina. He's got great hair, of course. And this Bloomberg snip that I'm showing on screen right now, evidently Bloomberg believes he'll only help rich people, and that only rich people want Argentina to end their economic slump. So, Bob, you've made some comments about media, and this is the kind of stuff that we see there, right? So,
turning off Bloomberg as you speak.
Yeah. So, with the Milei win, of course, the MSCI Argentina rallied. It's up 22% since October 31st, which is great. But Albert, what can Milei actually change? I mean, if you were in charge of Argentina, well, first of all, what could he change? And then if you were there, what would you change?
I don't know what he can change, to be honest with you. I mean, Argentina is riddled in debt. I don't, I have a suspicion that a lot of the debt is kind of not reported in some sort of special vehicles and whatnot, and they'll probably find out when they unload that just as he enters office. He doesn't really have a listen. I like him, right? He's quite a character. He says some crazy stuff, some stuff that makes
I can see you liking that,
right? Yeah, and I do, and I like the guy personally, right? But he doesn't have a support structure, right? I don't know who's going to be in his cabinet at the moment, right? Like his, rhetoric for elections is far different than actual policy when you're in charge of things, and I don't know.
Governance is hard.
It is hard, and I don't know what he can actually do, and I'm afraid that if he starts, just firing people left and right in all these different institutions, like that has to be all rolled up into something else. I mean, you just can't just eliminate an entire ministry of so and so without some kind of repercussions. So I don't know what he can actually do. I don't really have a positive outlook for Argentina, regardless of him or anybody else in charge for the next 12 months. But I like to, like I said on Twitter, I like to reserve judgment until I see who his cabinet positions are. Until you see that, it's really hard to make an assessment on the guy and what he's going to be able to do for Argentina. He's talked about dollarizing Argentina, which in principle, I agree with. It would absolutely stop hyperinflation in Argentina. But the reality is, with what dollars is he going to do this with? I mean, their debt is, enormous, and they don't even have enough dollars to dollarize. I mean, it may be a 5-year plan, perhaps, but overnight, it's not going to happen. I mean, I'm sure Michael can sit there and tell you more about the dollar and how they could possibly dollarize, but I don't see a viable way that his election rhetoric can match up with policies going forward in the next 12 months.
Bringing up Michael is a good point. Michael, you live in Greece.
Sorry, to understand, the dollar, in order for Argentina to dollarize, it will need another like Brady Bonds type of trick. The US government has to be on board, and they need to fund the Argentinian economy and make quite a few deals on this, make a few agreements, which I think is not that unlikely, given that we're also going into a geopolitical, conflict, if you want to put it this way. So if you look at the Cold War between US and Russia, you had spheres of influence. So I guess we're going to go through that again. And it feels to me that Argentina is closer to home in terms of the US. So the US will want to bring Argentina into their sphere of influence and help the new government in that sense. That's my feeling, but this has nothing to do with economics. It has to do more with a geostrategic view.
Okay.
Yeah.
I know what Albert thinks.
Yeah, the problem with that is Blinken has been notorious of installing leftists throughout Latin America. Look what happened with Brazil and then Colombia. So I have a suspicion that Argentina is set up to fail. They don't want a conservative in there to actually succeed in economic policies.
So can we just ask, Michael, you live in Greece. A decade ago or so, they were facing very difficult economic times. When you look at Milei, just kind of your top level assessment, do you think he can be successful?
Well, Greece had a blessing and a curse. The blessing and the curse was the euro, in the sense that because we had a hard currency, things did not collapse. That was the blessing. The curse is that because we had a hard currency, it took us 10 years to adjust. So it depends how you want to see it, and depends how, as Albert says, what the cabinet will be and what the policies will be. It comes down to pure, policies and economics on how they're going to deal with this. If they want to be serious, they're going to get the heat for 24 months, and then they'll be okay. If they don't want to be serious, this can last like for another 20 years, and we can be having this discussion every 5 years.
I'm going to have to agree with option B on that one. I just think that it's going to take a long time for Argentina to pull out of this, even with the policies. If he enacts some policies that are good, that'll probably be credited towards the next leader of Argentina, not Milei.
So let me just wrap this up. And I know Bob needs to go, and I know we need to give our viewers a little bit of time to digest this stuff. So whenever there's a win like this, and I've heard this in the States over the past couple of days, every person on the right wants to believe that it's a signifier of a bigger movement, right? Like, Milei's win means that geopolitics is moving to the right, all this other stuff. Do you think that's real, or do you think it's just a one-off?
I think that there's certainly a building momentum for conservative governments out there, but the fact of the matter is a lot of the leftist players control the markets and the media, and it's hard to actually displace that in the near term. I think it's going to be at least it's either going to be another decade before conservative governments take hold, or they're going to need some sort of black swan event or economic strife to the point where people are just fed up and don't want to hear it anymore.
Which is what happened in Argentina, but the question is,
we're talking about a global thing. Yeah, that's exactly right. We need a global thing. I think a good indicator would be what happens in Holland. That's the next election coming up right now.
Okay, just real quickly, tell us what's happening there.
Well, the leftist government has absolutely butchered the economy there, and I think the people are pretty much fed up. But the problem is even if the conservatives get in there, do they have enough to actually have a majority in parliament to lead a coalition? So that I don't even think that's possible over there at the moment.
Okay,
but we'll see.
Interesting. I mean, I think there's a lot to come in Argentina, as you say. If he doesn't have the people around him who can help him lead, it's going to be extremely difficult for him to have much of an impact. So, guys, I am so grateful for your time and your thoughts. I really appreciate this. Thanks. Have a great holiday weekend, and have a great week ahead. Thank you.
That's it for this week's episode of The Week Ahead. Please don't forget to rate us and review on whatever platform you are watching or listening to this. Thank you.